As an American, and as someone who believes in strong, functioning markets, I want to be clear about something right up front. I do not want Western exchange markets to fail. I do not want COMEX, London, or any major precious metals market to break down. A failure like that would not be good for the United States, for investors, or for the global financial system. This video is not about hoping for that outcome, and it's not about accusing anyone of wrongdoing. What this does is something different. It walks through a hypothetical stress scenario. Not how it could happen, not who caused it, but what happens next if trust in physical delivery were ever publicly questioned. That distinction matters. Markets don't usually collapse because of one event. They unravel when confidence erodes, quietly, over time. And when that happens, the real damage isn't in the headlines. It's in the mechanics. This is not a prediction. It's not a claim. It's an explanation of how markets behave under stress.
Silver is trading at two different prices, not because of speculation, not because of headlines, but because the market is beginning to split between paper pricing and physical availability. That's where this fictional scenario begins. In this scenario, the divergence doesn't close quietly. Instead, one delivery window is missed, then another. At first, it's explained away as a clerical issue, a logistics delay, a temporary settlement exception. The exchange assures everyone that nothing is wrong, but behind the scenes, metal that was assumed to exist doesn't move. Bars don't arrive where contracts say they should. Inventory reports become vague. Language changes. Eligible replaces deliverable. Deferred replaces available. Cash settlement quietly becomes the default. In this fictional scenario, that's when confidence starts to fracture. Industrial buyers, the ones who actually need silver to keep factories running, stop trusting futures prices. They bypass exchanges entirely. They go straight to refiners. They pay whatever clears supply. That drains physical metal even faster. ETFs are next. On paper, they look fine. Shares trade normally. Prices track the index. But redemptions quietly pause. Prospectus language is suddenly referenced. Extraordinary market conditions appear in filings. Nothing collapses in a day, but one large holder asks for metal instead of cash and is refused. That's when the story breaks. In this fictional world, global markets don't panic immediately. They freeze. Hedging fails because price no longer means delivery. Spreads blow out. Liquidity vanishes in the exact products designed to provide it. Silver doesn't rise smoothly. It gaps. Gold follows not out of excitement but credibility. Then everything tied to real assets reprices violently. Meanwhile, investigations begin. Not into silver, but into process. Emails surface. Internal memos. Risk committees that knew delivery assumptions were thin and signed off anyway. In this fictional scenario, blame doesn't land on retail traders. It lands on exchange executives who approved settlement exceptions, banks that sold what couldn't realistically be delivered, compliance officers who signed reports they didn't verify, fund managers who marketed physical exposure they couldn't honor. Some resign, some are charged, a few go to jail not for manipulation, but for fraud, misrepresentation, and failure to disclose material risk. Governments respond late. Strategic stockpiles are mentioned, then quietly protected. Export restrictions appear. Silver is suddenly called critical. The public realizes something uncomfortable. The low price they were shown for years wasn't proof of abundance. It was proof of control. And then the market changes permanently. Not because of a law, not because of a reset, but because trust, once broken, doesn't return. Now step out of the fiction. Look at where we actually are. A persistent divergence between paper prices and physical demand. Growing settlement flexibility. Rising reliance on cash instead of metal. Industrial buyers behaving differently than financial buyers. No failure has happened. No accusation is being made. But the setup exists. And markets don't break because someone predicts them. They break because mechanics are ignored. Until they aren't. The question isn't whether this fictional scenario is guaranteed. The question is how close reality is willing to drift toward it before someone asks for delivery and refuses to accept cash. That's why this matters now. Because when paper and physical stop agreeing, the market eventually chooses one, and history shows it's never paper.